solutions give consumers, borrowers, and lenders more choices, reduce risk in the system, all while basically improving the experience for consumers. But the promise of these companies, primarily from Silicon Valley, has been focused on the US. And in emerging markets where 90% of transactions are
Ladies and gentlemen, please take your seats. The session will be starting momentarily.
Well, hello everyone, and thank you for joining us. We were just backstage talking about all the great content at GES, even in this hour. And so if you're in this room, we thank you for your interest in the panel. And maybe you feel like I do. What an opportunity to be with these rock stars of impact investing. A lot of us know each other. We've worked together in lots of different ways, and I think we've really been looking forward to this time together. I'm going to briefly do some introductions of our panel, although I think they're known to most of you, and talk just a little bit about their background. And I encourage you, if you don't know them, to look them up after the panel or even during the panel to get a little more context about who they are and what they've done. And then we're going to have a little bit of fun, we hope. So I'm going to start with Andrew Beebe, immediately to my left. Andrew has done some really remarkable things, and today he's going to talk to us about some big bets that he's making. He's really been known for his work in clean tech and clean energy, and he is the managing director of Obvious Ventures. And we also think that Andrew's going to try to mix it up a little bit for us today. So welcome,
It's
Andrew.
usually your job.
Maybe we all will. We'll see how that goes. All right, Nancy Fund, I think really needs no introduction in almost any audience focused on impact investing. Gosh, I've known Nancy for about 2 decades. And she is such an important voice and leader. And I always hesitate to say pioneer, because when people say pioneer, it sort of suggests that maybe you're old. And Nancy, that's not the case with you. You just started so young. She had an awesome background in finance. And then with JP Morgan and with a lot of other really impressive firms, and in tech as well. And then in 2004, she created something called DBL Partners. And as part of that, she raised the first fund that was very impact focused, and she's going to talk about that work today. But she was also in the first institutional round of Tesla and got the 4th Tesla that rolled kind of off the floor. So we're going to talk to Nancy about some things today. And she wrote a blog that we're also going to ask her about. Matt Bannock, woohoo! Omidyar Network. Matt has been everywhere in impact investing, and I think I have a special place in my heart for Omidyar, because at the Case Foundation, and for my husband and I, we'd been doing impact investing, but we didn't know there was a name for it. And then we really wanted to get the foundation engaged, our family foundation. And to be honest with you, we were a little concerned about it. It was a space we didn't understand, so we called our friends at Omidyar. They literally took us by the hand. And I think we wouldn't have gotten as deeply engaged as we've gotten without really the help and the partnership and the friendship of Omidyar. And Matt's gone on to do all kinds of things, including serving as co-chair of the U.S. Advisory Board to the G8's Impact Investing Task Force. So welcome, Matt. Jacqueline, you're way down there. These chairs are really big.
They're far.
I know. Jacqueline Novogratz is from the Acumen Fund. And Acumen's 15 years old now, Jacqueline? I've learned a lot from listening to and watching Jacqueline's work in the space. I think she's a true innovator. She has amazing global impact through her work, and we're going to talk to her about some of that. And I think she not only has vision, she's really brought wisdom to the space. So I'm sure you agree with me. Great panel. We're super excited to get started. Now, before I actually launch into questions, we want to do something a little bit fun. So in celebration of GES, I wrote a blog, and the title of it was Impact Investing. Is it a houseboat or is it brunch? You might go, what's up with that? So one of the things we really try to do as we're trying to take the movement forward is listen carefully to our skeptics out there. We always want to know, what are kind of the arrows that are being thrown at us, the big questions that people are asking. And I kind of feel like the 2 extreme sides, if you will, could be summarized in 2 comments I heard through time and different things I've been engaged in. One by a celebrated Silicon Valley venture capitalist, Marc Andreessen, at a Forbes conference I was at with him. He referred to impact investing this way. He said, impact investing is a houseboat. It's not a good house, and it's not a good boat. So think about that. That's one definition over here. Fast forward the tape. Nancy taught a class at the Yale School of Management on impact investing, and she was kind enough to invite me to come guest lecture, which I loved, as Nancy knows. And, it's kind of this college-style room, different tiers, and guy in the back kind of raises his hand, and after I talked about the houseboat Marc Andreessen quote, and he said, I think impact investing is like brunch. It's better than breakfast and better than lunch. So we don't know how our audience breaks down. And before we get started, we were kind of interested in finding out. So I'm actually just in sort of celebration of Brexit and the UK, okay, and what's going on over there. We thought we'd do our own vote here in Palo Alto today. So think about it, and I'm going to ask for a show of hands. Do you come down on the side of houseboat or do you come down on the
Are you
side of
raising your
Brunch?
No, I'm just, I want to see the answer.
You want to be able to see, yeah. I know, it's hard
We're
not
going
to
to
see
get an
as
answer
we have
here
like-
sooner than
guy
anyone.
All right, so
Stage.
those voting for Houseboat,
Control.
please raise your hand. And be honest, we want our skeptics to be known. Okay. Those voting for Brunch?
Oh.
Ooh, wow, this is going to be fun. Okay, and then those who are really here saying, I don't know, that's why I came to the panel, to find out what impact investing is. All right, we've got some of those too. So we thought we'd have a little fun. We have lots of topics that we're going to try to cover, and so if you find us talking fast, it's because we want to get a lot in. And we're going to try and leave the last 15 minutes for questions. So please, if you have questions along the way, hold them, and we'll call on you. We have some microphones that will come around. So in that same blog, I really tried to address 4 myths of impact investing. And I'll just run through them quickly, and then I'm going to ask some of our panelists to comment on them. Myth number 1, that with impact investing, you have to sacrifice profit for purpose. Myth number 2, impact investing cannibalizes philanthropy. Myth number 3, market is limited to do-gooders. The serious, savvy players haven't really jumped in. Myth number 4, impact investing won't go mainstream. It's really only for the rich and the privileged. So I'm going to turn to the middle and ask Nancy to jump in. Give us your thoughts on some of those myths. Pick one and see if we can either debunk it or say why it's kind of a valid concern.
Well, thank you, Jean, for your very kind introductions and for telling our Yale story, which was just so fun. And Jean is such a leader in the space, and we're lucky to have someone as committed to spreading the word as you are. So thank you for that. And we need to spread the word because there are skeptics out there, and it's ridiculous. I mean, of course you can invest for profit and pursue purpose. I mean, you can walk and chew gum at the same time. This is a bias. It's not something that's rooted in empirical evidence today. The reason that this bias persists is that perhaps in the early days of this field, where people were mission-oriented but maybe didn't have some of the financial disciplines and skills, there were some efforts that didn't quite go the way that we would like to see them from a return on investment point of view. But those days are long gone. We have so many proof points across the globe of the ability to invest with your head and your heart, I like to say, because you look at a company, you mentioned Tesla. There isn't a company on the planet right now that has changed transportation more than Tesla in terms of sustainability and unhinging us from that 20th century model of a fossil fuel-based transportation system. And look at its market cap. It's probably about half of what GM is, even though it's only been around for 10 years, and GM was founded in 1905. So what we're seeing are more and more companies that are able to develop the stories, develop the valuations, and develop the brand. And I think we'll talk more about this. If we can get more of those brands out there of entrepreneurs that kids want to grow up to be like, I think we will be able to put to rest this terrible myth once and for all.
Great, great. Yeah, Matt.
Yeah, also just echoing our gratitude, Jean, to you, not only for this panel, but for your leadership in the realm of impact investing. You're one of the finer voices out there, and we really do appreciate it.
Thank you.
I would argue, because everybody will tend to agree here, so I want to push some of these discussions a little further. I would agree on the one hand that absolutely there are opportunities where you can generate strong financial returns and terrific social impact. Those exist. But I think we've gotten into this somewhat stale argument, right, where some people say, yes, you can generate risk-adjusted returns and have social impact. And there are other people who say, no, you can't. And it goes back and forth. Yes, you can. No, you can't. Yes, you can. No, you can't. And you're missing the fundamental question, in my view, which is, under what conditions is it reasonable to expect risk-adjusted returns? And under what conditions is it more challenging? Now, I love C.K. Prahal's book about the fortune at the base of the pyramid. Let me tell you, it's really, really difficult to serve customers $1 a day, $2 a day, and get risk-adjusted returns, right? So first, for a lot of us who are interested in impact investing, to the extent that we can bring business discipline to having a positive social impact in the world, we first got to think about which segments do we want to serve? How do we serve them effectively? And to be quite reasonable and wide-eyed, about what our returns expectations are. And sometimes, if you're serving a particularly disadvantaged population, maybe 2% is a fabulous return. It may be a fabulous return. So at the Meteor Network, we talk about investing across the returns continuum and being very clear-eyed not only about the returns you're going to get, but about the social impact that you're going to drive.
Yeah, and I think that's a really important point, and I think a lot of us have been trying to make that clear, that there is a continuum. There's a spectrum, really, where there are some investments that are concessionary, but there's growing research and evidence, and we should talk about some of it, that clearly points out across certain asset classes, market rate returns are there. And so I think when we talk about the fact that you don't have to sacrifice profit for purpose, we do recognize that intentionally some investors are comfortable with that based on exactly what Matt just talked about. So, Andrew, let's turn to you. And I should say, I probably should have said this at the open. For purposes of this panel, we're using impact investing as defined by an investment that produces both a financial and a social return, that both have to be present. And the social impact has to be clear intention known to all stakeholders, transparency, and a commitment to measurement going forward. Now, you're not such a big fan of this term impact investing. Talk to us about that.
Yeah, okay, this is slightly uncomfortable because Jean has asked me to stir the pot, and yet I'm asked to do that with a group of panelists that I just have the utmost respect for. So this is challenging. I sort of just want to yield all my time to Nancy. Nancy is my hero, and hearing her opener was sort of, this is our playbook in many ways. However, her firm is called Double Bottom Line, and ours is not, so I will at least take a view here. And I think our view is advantaged by the fact that we're coming a little bit late to the party as a firm. The firm was started 2.5 years ago, and we get the advantage of all of the work that's been done by everyone up here on the stage in transforming thoughts about how investment works. So what I would say is I think, and this is an aspirational statement, but I think that impact investing is redundant. I think that the phrase impact investing at least should be made redundant. When we think about long-term investing, when we think about building the enduring companies of the next century, it should be self-evident that they will have impact. If they don't have impact, they're not going to be here in a century. Witness the 5 largest coal companies in America all going bankrupt in the last 15 years. When I started as an entrepreneur in solar 15 years ago, if somebody had told me, hey, what you should do is short all the coal companies, you'll make a fortune, I would not have expected the outcome that's come to fruition. And obviously we've seen that traded in value and creation in terms of the solar industry. So what I hope is that we're moving into a realm, and I think we're seeing it again and again with some of the larger venture firms out there starting to use the world positive language and the language that other people up here have pioneered, just talking about we are looking to solve the world's biggest problems. If you do that with technology and with great teams and with the same metrics we use in venture, you will have outsized returns. And I would look to Steve Jobs and Wozniak. I don't think they got together and said, hey, we probably isn't going to work out economically, but this will have a big impact for a year or two until we run out of money. I think they said, let's change the world, and the rest will follow. Larry Page, same thing. Ev Williams with Twitter, same thing. I'm sure Steve with AOL, the intention was, let's change the world, and we will have great economic outcomes at the same time. So that's our belief. And to answer the question, one thing I'll really disagree with is on the measurement front, the way our firm works, we put the screen up front. And we know that as all of us being former entrepreneurs and working with entrepreneurs day in and day out, there are pivots along the way. So to try and set up, especially at the seed and A rounds very early on, try to set up metrics now and measure later is tough. But if you say up front, what's your commitment to being world positive and doing something transformational for the planet and all of its inhabitants, when you get that on record, just that commitment, then you can start to just use basic venture economics to make your decisions.
Yeah, good points, Andrew. So Jacqueline, when I think about impact in the world, I do think about our global world and particularly emerging market opportunities in the developing world. You've been there on the front lines for a really long time. So how do you see sort of what's happened with impact investing in the years you've been on the front lines, and any thoughts on the myths that we discussed? And I invite the panelists to jump in as we go, by the way.
Thanks, and thank you, Jean. I want to jump in on the thanks to you. It's exciting to listen to everyone, and we actually agree on so much. I would, in a way, say what we're all saying with slightly different language, which is that when you think about what Secretary Kerry was talking about this morning, the enormous changes the challenges that we have as a world and how all business needs to be thinking about solving those problems, what Andrew's saying, we are now moving hopefully into the age of transformation away from just technology to a place where all of us have to be thinking about problem solving, not just returns, the highest returns that we can get to a group of shareholders. And so when I think about impact investing, I actually think that the question is not Houseboat or Brunch, but can we agree that investment is a tool, it's a means to an end, and can we get clear with what our ends actually are? And so from Acumen's perspective, we go out not from the perspective of we want to invest and do good. We go out with the perspective of, like you were saying, Andrew, we want to solve the biggest problems on the planet. And what we've learned over the last 15 years is that there are some markets that are now more market ready and where low-income people see a return themselves to the decisions that they're making to get access. So 10 years ago, when Omidjar and Acumen were investing in solar energy for the very poor, people who make $1, $2, $3 a day, pretty hard to make any money. It's been 10 years, and now that market is more ready. Because 10 years ago, like many of the markets we work in, there was not only no infrastructure, there was people making $1 or $2 a day, there was no trust. Well, you had a lot, and there was no data. You had a lot of corruption, bureaucracy, mistrust, and a lot of myths. And so it takes a while to build. And so when I think about impact investing, I think about the tools that are needed along the spectrum that include grants, that include what I would call patient capital, philanthropic-backed investing, all the way up where you're looking at, classic VC returns. But we've got to move away from what Matt, I can't agree more with what Matt was saying. We're getting stuck in this nomenclature stuff, and we need to be acting more and putting our money where our mouth is, recognizing that this is the moment to create real change.
Yeah, I agree. And let's talk a bit about measurement if we can. I think you made a good point, Andrew. For those of you that know B Labs, B Corps are kind of considered, almost like the platinum version of impact. No one really questions their commitment to an impact, that they've stated it and that they've committed to measure to it. But we had noted for some time that there were about 1,500 B Corps. I think there's like 1,700 now. But there were 10,000 companies that were using their tools. It's like, something's going on there. And so we partnered with B Corp and Measure What Matters, and today 40,000 companies are using their tools to measure their own impacts. It's not signing up to be full-on B Corps, right? So how do you see the continuum, and how do you see, and Jacqueline, what you just brought up, and then on the funding side, do you think we'll see new mechanisms? Do you think there will be new patient capital that comes in that says, I'm actually okay not to exit for 10 or 20 years. Mm-hmm. I mean, so how do you guys see sort of this messy time and how it might go forward?
Well, I just want to push back a little bit on Andrew, whom I'm a huge admirer of. But
you can be an admirer and push back on him, man.
Bring it on, Nancy.
He's also my friend. But if you don't measure stuff, you miss out on half of the ability to change. And just an example from our early days, I mean, diversity is so on message now. We're trying to do a much better job. Wasn't the case 12 years ago. It wasn't as front and center. And if you can believe it, I mean, we have all these metrics on low income placement, on climate change improvement, on job creation, but we didn't have a diversity metric, even though we had senior women in a venture capital firm, which it was and continues to be somewhat unusual. And one day we just looked at our companies, and like Revolution Foods, started by two amazing women, Kristen and Kirsten, and we said, wow, we have a lot of women founders. And we were like, well, how many do we have? What percent? And it was like, oh, well, we have 25% women founders. And we're like, wow, that seems high. What's the average? we didn't even know. And so we found some study that Babson had done, and it was 2.7% of entrepreneurs in venture-backed companies are women. And so we're like order of magnitude. And we were just, we were happy that we were above the average, but we were devastated that the average was so low.
But you accomplished that without measuring it.
But then
I'm jumping in on my side too.
That the point is that we were like, oh my gosh, we are so stupid. We need to include this. We need to measure everything and then help our companies improve their numbers.
Right.
And that's, and you don't do it preachy. You don't do it, you're really bad. You don't have enough women. You don't have enough minorities. You just say, you're missing an opportunity, and here, let us help you.
Yeah.
And so, I mean, there are lots of examples like that, but that's one that now that we measure it, we actually have better tools. We refine it in our most recent fund. It's early days, but 9 companies so far. 6 are run have a woman in the founding team or as a CEO. That just didn't happen. And if we didn't measure it, we wouldn't be able to celebrate it either.
Right. I agree. Jacqueline, were you going to chime in on that?
Well, just jumping in on what Nancy's saying, because we look at a different set of metrics, because I also believe that that what we choose to measure is a reflection of what we value. And so really, Omidyar has been partnering with us, but we've been developing something called lean data. And over the last years, I think we need to have not only rigorous metrics, but they've got to be transparent, as you said, Jean. They've got to be easily understandable. And they've actually got to move away from just being used by one stakeholder group, just the investors or just the company or just, in the case of people making $2 a day, the customers have never really been seen as very important. As a result, most people working in low-income markets know very, very little about their customers. What lean data does is take the tools that we now have through mobile cell phone platforms, and we can text 10,000 customers at a time of a single company and get real data on their income levels, not by asking them direct questions, but a series of questions about their roof and do they send their kids to private schools, et cetera, so that we can actually know if we're serving low-income or middle-income people. The savings that they're getting in terms of income as well as in terms of days per month where they can now work. So for instance, we have a cook stove company that called Burn in Kenya. Cook stove is just a normal stove, but most of them use charcoal, which is made with wood in East Africa. And what we're learning through this mobile platform is that people immediately save 50% a day overnight from what they used to spend on. On average, women are gaining 5 days per month. We now know the number of trees that no longer have to be cut down, so that we can start to look at a company and recognize the good it's doing in terms of the positive externalities, even though we might have to bring in different kinds of capital to enable that to happen. We know the good that it's doing in terms on the health front, on the income front, and importantly, the women now and the customers now feel empowered to give us information back and give the company information back so that they can create new products, including savings products, so then they can go on and buy other life-enhancing types of products. It's the first time in 35 years of doing this work where I've seen companies feel not like they're being monitored for impact and everybody's playing a game with each other, but they're actually asking us now to do this stuff early for them so that they can serve their customers better, get bigger contracts, have greater transparency, and it starts lifting what we value so that we can define success on a stakeholder model and not, again, for just shareholders. And I think that is why my dream is maybe coming to where you are, Andrew, in a different way, but that we don't need qualifiers, that every investment insists on impact. And we as a world are saying, our earth is too precious and our people are too precious to not be investing any other way.
If I may add to this too, and we're very excited about the work that Acumen is doing with lean data, and it's fabulous, and we're just really at the beginning of seeing what that can do. I'd make a few quick observations here. First of all, if you're an impact investor, you care about impact, you should be able to measure impact. Second of all, agree with Andrew, when you're dealing with an early stage startup and you want to co-invest with venture firms and you come in and you have a list of measurement demands, you're not going to get the investment. You're not going to be able to have a positive influence on the firm.
But you don't have to do that. You can do.
Right.
I mean, you can be more sophisticated in the way you do it.
Well, so this is going to be my next point. I think the key is to, where it works really well, is when you invest in firms where impact is embedded in the business model. What do I mean by that? So Jacqueline was referencing D-Light. If D-Light, the only way they succeed is by providing solar lanterns to millions of people. That's the only way you succeed. So you don't spend a lot of time up front asking them to measure a bunch of things.
It's
They're
embedded
providing
in their model that they'll have more impact if they have more D-Lights out there.
And they're now moving with another investee of ours, Off Grid Electric, into home solar systems. In Kenya, one of the really exciting things is that the daily cost of a home solar system now is below the daily cost of kerosene, right? Absolutely critical moment. And so that segment is taking off. We know there have been lots of studies about the positive impact of having lighting in your home on education, the ability to study, store hours, all those sorts of things. So that's the baseline. So you invest in a company where you say, hey, as you go from 100,000 to $1 million, we know you're having much more impact. So impact is embedded in the business model. The only way they succeed is they meet the needs of that customer base.
So let's pull back a little bit. If you're not a close follower of the impact investing movement, you might not know that the last 24 months really have seen extraordinary momentum in this space. There have been a lot of big changes, and we've all talked about them together as they've taken place. A couple of them are that big finance has moved in. Bain Capital brought the former governor of Massachusetts in to run their impact. We have seen BlackRock come in, and BlackRock's doing some interesting things, which is looking at their whole portfolio. And in this conversation we just had about impact, we have a friend, Clara Miller, and she likes to remind us all investments have impact. The question is, what impact do they have, right? We're talking a lot about really aiming high and looking for sort of social benefit, social good impact. But there's impacts that are the opposite of that as well. And it kind of goes back a little bit to what you said. So if we sort of pull back and we say, wow, there's a lot of momentum, a lot of changes here. Matt, as I mentioned, you led the U.S. task force to the U.S. Advisory Board to the G8 on impact investing. And through that, there were some policy recommendations. And one of the things, so we saw big finance move in. Some of those policy recommendations were to open the door for pension funds to do impact investing, and for foundations, some clarification of language to really serve as an inspiration and encouragement to get them to do more impact investment. What will that mean to the movement? I mean, we sort of have a sense now that there's a lot of momentum, but what does that mean? Talk about that a little bit.
Yeah, so first of all, Jean played a key leadership role in the National Advisory Board, and we're hopeful that obviously the impact is going to be extraordinary. A lot of folks are excited about the ERISA regulations, which seems sort of like wonkish to many to say that one can now consider social and environmental considerations when making investments. People say, oh, that's kind of wonkish, but in fact it's just such a change in ERISA regulations that helped spur the acceleration of the venture capital market when it was deemed that venture capital-like investments could be considered as legitimate investments in per ERISA. So we're hopeful that that's going to spur a lot of positive momentum in terms of additional capital in the space. And the PRI regulations, again, also pretty wonkish.
For foundations, right?
Will enable foundations to invest more in impact investing. From my perspective, in order to drive this, the movement forward more rapidly, there's not really a shortage of capital, right? There's a lot of people out there who are really quite interested, anxious to invest in organizations that will drive positive social impact and generate big returns. We were able to host a Gates Giving Pledge session a few months ago where Jean and I attended. And there were hundreds of billions of dollars of capital represented in that room, and a lot of those people really were wanting to engage in impact investing. One of the big questions was where are the investable opportunities?
Absolutely.
Right? And what is the on-ramp to get into impact investing? And these are people who have a lot of capital. One of the questions, interesting questions, Jean, and you pose this in your article as well with some good examples, is okay, if that's what the issues that the very wealthy are struggling with, what is this? What are the implications for the average investor
Correct.
Who wants
For
to
every
engage
man.
in impact investing? What are those sorts of, because that's, I think, when we really can go mainstream where we'll get that extraordinary momentum.
So talk about the ecosystem. What's missing? What do we need to be focused on?
Well, certainly we need more practitioners. And I say that remembering the early days, how difficult it was to get started, even though I had a traditional venture capital career. And sometimes I think people are too demanding of this field. I mean, it's kind of like, it's don't let the perfect be the enemy of the good, because there are plenty of, in my asset class, there are plenty of venture capitalists that are fantastic, and I mean, it's a bell curve. There are people that underperform and overperform, and yet funds are raised, institutions, high net worth individuals, endowments come in, and that's kind of accepted. It just, in impact, it's kind of like everyone has to be a superstar, and if you don't have, a track record, and you don't have an IPO, and you don't have exits, I really don't think I'm ready for impact. And so I think some of the intermediaries that have come into the market to calm people down about having their sights way too being too picky is helping a lot, because we'll never grow enough firms like Obvious and Acumen and DPL if we don't take some risk, if we don't back some people when they don't have a perfect portfolio.
Andrew, you want to comment on that?
Yeah, I totally agree, and I would just go further to say the other piece of the ecosystem that we see wanting or lacking is we have billionaires sitting together in one room, and then we have hundreds of amazing entrepreneurs coming to events like this in a different room or an auditorium. And those pools are not connected enough.
Yeah.
So in Silicon Valley, over 65 years, we built a venture industry based on this amazing machine of Silicon Valley, plus maybe Northern Virginia, plus maybe 128 in Boston or whatever, but basically Silicon Valley. We need to be, and we are, and this today and tomorrow is replicating that in a much broader sense. And that means a global sense, but it also means an acknowledgement of an entirely new class of consumers and a whole new way of looking at consumption in the world. And I want to just toss in the millennial component on this, which is we see again and again on a brand basis, millennials and all sorts of people, but there's a movement driven by a younger generation to put the values of the company first, as opposed to a nice to have, it's a have to have. So I think 10 years ago it used to be, oh, that's great, I love my soda, and it turns out this bottle is made from plants or something. Now the question is, wait, tell me about this company, and are they really looking out for me? Is this really sugar or some other chemistry that's not going to be good for my body? They put that first at the company level before they make their decisions. So the demand is extraordinary. We just need to start connecting the pools of capital and entrepreneurship in a more institutionalized way like we've done in other industries.
I would just second that. I mean, just when we started, we were a little bit, we weren't as confident, but we had our entrepreneurs sign a letter that said, we understand this is a double bottom line fund, we're going to work with you. But to your point, we didn't want to be too aggressive and get kicked out of the deal because of it. But we wanted to honor it, and it turned out that a lot of our entrepreneurs love signing it. But fast forward to today, as Andrew says, when we lead a deal now, we actually put it in the term sheet. And the entrepreneurs want it that way, and they're excited, and they want to. That's one of the reasons that they like to have us involved. So I think Andrew is really onto something. We do have to capture what millennials do best, which is to bring meaning into their lives in all facets.
Right. It's funny because what Matt talked about and what Andrew just really connecting all of the comments here, we have sort of said we need an eHarmony for impact investing, right? We're like the great impact investing entrepreneurs can find the people who are really passionate about funding them. And there is, no question, a perfect storm of a new generation, a new class of entrepreneurs coming on the scene who aren't satisfied with just profit. Okay, the question that comes to me from the business school students that I spend time with and the university students, they say, why would you just settle for a financial return? It's a really interesting way to think about it. There's also a new class of investors that are out there, and they're beginning to age into the investor class, and many of them are these millennials we just talked about, but not all are. So it's an exciting time. But Jacqueline, you do work in really faraway places, in communities where a lot of people haven't had experience. How do you find what you fund, and what do you see as the state of these connections or bridges where those with great ideas can find those that want to fund those great ideas?
Well, it's been so exciting meeting so many of the young entrepreneurs here, and the way that we find it, and Omidyar finds our entrepreneurs, is the way, in a funny way, that Silicon Valley does its networks, and your best network node is usually other entrepreneurs. But what's so interesting when I think about, as I was listening to both Nancy and Andrew speak, the difference, I would say, for many of the entrepreneurs getting started is that, and I felt this very much when I spoke to a number of you last night, is that there's a real role for grant capital and seriously high risk angel, early stage investing. That's part of the solution, but if we really want to look at the ecosystem, there's a talent piece here. And so for the link, it's not just where can we find the right capital, and too often I hear young entrepreneurs looking for capital only. It's the advisors and the ones who will connect you and help you kind of navigate. And then as they start moving up the curve, if you will, to take on different kinds of capital, we're starting to see more patient capital and impact investors, which is really thrilling. Where the ecosystem is still really broken for companies that are serving very low-income people is that we don't have working capital financing. So we've got to get different kinds of financial institutions here, and here's where government can really play a role. We do often have entrepreneurs have to work within systems where the courts are not that helpful, and so they have to figure out ways almost to go around the courts. So we need to start really, what Secretary Kerry talked about, really work with governments locally to create more of a level playing field and a runway to enable these companies to move forward. So what's so thrilling to me in the impact space is we're actually seeing these ecosystems start to move outward. And when people think of themselves as working in the space, by starting with the problem that we're trying to solve and not putting your flag in the ground as to where you stand, there is a role for the grant makers, for government, for the civil society workers to get awareness out, and certainly for working capital and other kinds of lending institutions.
Great, Matt, hold your point for just 1 minute. We have a couple of hands that are already going up, which I love, okay, because we want to hear from our
Can I make
audience.
just one quick
Go
point
ahead.
to
And I just
Jacqueline's?
wanted to add to
Why don't we had a question right here in the second row, if we can bring the mic down to get started, but go ahead.
So just to put some numbers on Jacqueline's point about dearth of patient capital, there are $50 trillion of profit-seeking, return maximizing investment capital out there. $50 trillion. In grant capital in the US for foundations, it's about $45 billion. 50 trillion, 45 billion.
Right.
Between those two, profit maximizing and grant capital, which is 100% guaranteed loss of principal, there's maybe a couple $100 million a year. Maybe $1 billion a year. 50 trillion, 40 billion, and one's the stock flow, yes, but it's still a trickle, right? So I think there's a good question about whether more profit-seeking capital is really additional in the impact investing field. I think we got to encourage people to take more risk, earlier
right.
stage, in
Be
tougher
fearless.
markets
And
to really
take that
grow some
philanthropy
innovation.
to back it.
And
All
I
right,
think
let's go over here to our first
Can I
question.
just say one thing?
You'll get to your question, I promise.
Just adding to Jackie, what we have seen, I mean, we just did our first investment in off-grid electric in Africa, and what we learned is that a lot of people took comfort from the fact that a very profit-oriented impact firm was investing in the company, and that helped to allow the company to attract a loan fund from high net worth family offices, foundations, that maybe wouldn't have gone in before.
Yeah,
So I think
so it's
very
leveraging. Yeah,
knitted
that's
together.
really terrific. Right here, I think.
Hello.
Hi.
My name is David Munir-Napti. I'm a native of the Bay Area, but I actually have been living in Lebanon and working out of the Middle East for the last 12 years. And much of this is very heartwarming to hear, but the situation looks very different on the other side of the pond. We look at many maps of the world and where a lot of impact investors work, and from various events ranging from Skoll or SOCAP or WEF, et cetera. Even here today, I saw a map from a group that was working around the world, and they had dots in every part of the world except the Middle East, except the Arab world. And I wonder if there's actually a bigger reset that needs to happen, a fundamental shift in terms of how the system works. Because I think that one of the greatest injustices in the US is how education funding is tied to property taxes. And that sort of situation is continued forward and exaggerated by how this sort of investment in risk capital works. There's such massive inequity around the world. They talk about how in Silicon Valley there's more investment in innovation than the entire rest of the world combined.
Yeah,
and some of these systems are sort of perpetuated, even by saying that one of the examples is D-Light, which came out of Stanford. It's a great product, but it's looking at the innovation coming from here and looking at the rest of the world as a consumer base rather than an innovation hub. And how do we shift this situation entirely so that much
we've
of
got the
this
question.
funding
Thank
is
you very much. So I do want to say before I throw it to our panelists, I had the privilege of serving as the co-chair of the U.S.-Palestinian Partnership. And in that role, we were able to stand up the first venture capital fund that's exclusively funded tech entrepreneurs in the West Bank. And we saw that as very much of an impact play. So that map was wrong. At least in the West Bank, there should have been a big old pin. But does anyone want to comment on the question?
I do. I also think that we're seeing incredible entrepreneurs in the developing world. And almost every entrepreneur that Acumen invests in actually comes from the developing world in Pakistan, India, East and West Africa, and Latin America. I think to this whole conversation that we're starting to see a mindset shift that we need to grasp and run with because it's so exciting. And for the first time, USAID actually gave us grant capital to go into the post-conflict areas of Colombia to invest in for-profit companies to help them become more profitable because the impact is embedded into this, what they're doing, but there's no trust. They're tiny communities. There's no possible way we're going to come in and be like, throw down that money and we're going to give you 20% returns in 6 years. Ain't going to happen. So to start to see government and philanthropists recognize that we need to create new pools of capital to enable economies to start to help themselves is really thrilling.
Great.
So I think we're seeing real change.
Thanks, Jacqueline. I think we had another question right over here. And then we'll come over here.
Hello. Thank you. Hi, this is Manu from Germany. I'm serving on Professor Yunus Young Leaders Advisory Board and working with the Global Shapers, so the whole thing is close to my heart.
Great.
But my main job is I'm a co-founder and CEO of a healthcare startup, spin-off of 6 universities in Germany. And things are going pretty well. So we are the first partner with the German health insurance company allowed by the government, fighting dementia. All these things are going quite well. We raised more than 500,000 euros. Half of that coming from governmental grants.
Great.
Half of
You have a
that
question?
business angel. The question is, now that we're talking to impact investors, I get the question all the time, we cannot invest in you guys because you have private business angel money, and we're afraid as an impact investor that once you have business angels from a classical startup world in it, you will have a huge conflict of interest. And my question would be, is that only a German phenomenon, European phenomenon? How do you handle that?
Who wants to take that one?
I think you're talking to the wrong impact investors.
We say bring it on.
Yeah.
Well, but also this is, I think, Nancy's point about she's building it into the term sheet, and so if you had started with that kind of an investor, you would get both. You'd be able to say to all the subsequent investors, look, I've got private money, but it's private money that is perfectly aligned with our long-term vision of where we want to go.
Yeah.
Well, and even if it's not, I mean, if you have a board and you've got a commitment, in this company in Africa, Total and EDF invested alongside of us. I mean, I wouldn't call them impact investors, but they know, they have a view as to why they want to transform Africa from a fossil generation to a green one. And so you find areas, it's like any negotiation, you find areas of commonality and you work together on those.
That's right. So we have a question over here. Mike's right next to you there.
Hi.
It's on.
Hello.
Yeah.
Hello. Hi. Jonathan. Hi. I tend to look at impact investment the way the Supreme Court looks at porn, which is to say I can't define it, but I know it when I see it, right? Now, I've transitioned most of my portfolio into impact, right? I have a small managed portfolio. That's not. And what I mean by that is to say I'm all private, right? Now, I have a lot of disagreements with people who run funds that say there's impact in the public markets. And I don't believe that Walmart changing their packaging counts.
Okay,
impact,
what's your
right?
question?
Prove me wrong. Tell me that where is the impact in public markets? Can I be an impact investor in a public
It's a
market?
really great question.
Thank you. I think so too.
I mean, I think you have to have a broad portfolio, and I mean, most leading big companies are public, and so you can't say I'm just going to ignore most of the world. and what obviously when you're in private companies, you get hands-on, you get to shape the culture. I mean, that's why I like it better than public stocks. It doesn't mean that you can't make a difference in the way public companies are run. I mean, there are movements around diversity on boards, there's divest, reinvest, and you can engage. And I think you've seen the pension funds play a big role in cleaning up a lot of our corporate practices. So I would say you've not only can you must. Right. We've got to lift everyone to a higher standard.
Do you want to add something? We have a question down here. Andrew, did you want to ask something?
The simple answer is Tesla was private, then it was public. Of course, you won it on both sides of that. But I would also say there is structural change that we can, of course, address. And I would refer people to long-term stock exchange and other efforts that people have out there to transform the way we think about markets, supporting public companies that have a longer view.
I think that's right. I think right here. Oh, I'm sorry. Go ahead.
Hi, I'm Megan McCormick. I'm working to end unemployment in West Africa. And a lot of what we see on the ground is there's great work of impact investing, really putting money into high impact companies. And then there's microfinance on the other side. But what I really care about is job creation. And to do that, we need to invest in the small, medium business sector. So what needs to change so that impact investing can be a bigger player in enabling job creation and SME growth?
Do I? Well, again, I think Matt and I kind of talked about it a little bit before, that we're starting to see this happening at the smaller end. I think that crowdfunding is something that we really need to look at more, and what Kiva has done has just been spectacular. And some of the companies that we've invested in, like Sanergy, which actually creates franchises of toilets in slums, picks up the waste on a daily basis, converts the waste into fertilizer, and commercializes the fertilizer on the market. For each of those toilet owners, you need a loan. They employ people, but a company that's trying to, I mean, let's face it, commercialize human organic waste into fertilizer has a lot on its plate already.
Pardon the pun. The really bad pun.
Metaphor.
And off the plate.
Sorry, off the plate. But so who is going to make the loans so that individuals who are tethered to a company are actually going to increase and enable themselves as jobs? Because one of the issues that microfinance has is it's often selling lettuce in the street. And that's a hard thing. We know that a lot of jobs aren't created in that way. So what's exciting to me is to find these kinds of new mechanisms that are allowing individual franchisees or entrepreneurs that are connected to larger system. And I think off-grid energy could be a complete game changer. We need to be smarter about those sectors. We need to find ways to get that early stage. It's also exciting, again, to Matt's point, to see efforts like Mercy Corps and Village Capital that are raising funds to make $50,000 and $100,000 bets on these early stage. This is where the capital is incredibly scarce.
Well, I think that's why you need more equity capital in Africa and other developing markets, because you can sustain losses as a company for a certain amount of period if your investors go in with their eyes wide open and tell you to do that.
There's a lot of really interesting and exciting stuff going on generally in financial inclusion, including in Africa. Everybody here probably knows the story of M-Pesa. 70% of Kenyan GDP now goes through M-Pesa. The story goes beyond M-Pesa because now M-Pesa enables so many other businesses across Kenya. We've invested in 3 different mobile money solutions, including in Indonesia, Zambia, and there's also interesting microinsurance. Insurance is a big problem for most Africans. We've invested in a company called Microinsure, which by bundling its service with mobile carriers, initially on a free basis, they now cover tens of millions of Africans who previously have not had insurance. There's a lot of really exciting things going on.
Okay, I think we have a question over here. And you can see, we could go so deep on any one of these questions, but we're really trying to go through so we can get a lot of questions in.
Hi, I am Leticia Gasca from Mexico. I work for the Failure Institute. We do research about entrepreneurial failure. And right now we are doing a research about why social entrepreneurs fail. And my main concern is the potential damage that can be made when a social enterprise shuts down, because you're not only failing to your investors and your employees, etc., your usual stakeholders. Probably you're creating a negative impact in a population or an ecosystem you were originally trying to help. What's the responsibility of the investor in these cases? Thank you.
Well, again, this really irritates me. I'm sorry, because it's hard to create successful companies, and a lot of companies fail. And for all the successes we talk about, we need a whole nother session to talk about our failures. And you can't have, as I say, the perfect be the enemy of the good. You have to accept that there will be failures, and you've got to pick yourself up and learn from them and move on to the next. And I think that one of the things about social enterprises, why I like to see a lot of them get bigger, is that they can employ more people to make up for the fact that there are sometimes smaller companies are more vulnerable. And so you do need a mix. But I don't think you can blame people for investing in companies and then not having 100% success rate. I mean, that's just
But I think that's misunderstood, really, in the world more broadly, that actually, there's some data that suggests most ventures fail. Forget impact, having nothing to do with impact.
Well,
okay? Startups fail commonly, whether there's impact or there's not.
That's right. Just 2 quick examples that may also provide some illumination. Well, one of the hardest decisions we had to make was actually closing down 3 maternal health care clinics for low-income women, which is just a miserable decision that you have to make. But what we understood, which is what Nancy's talking about, was that if we didn't have the courage to make that decision, we were going to see 9 maternal health clinics fail. And so we shut them down, we restructured the company, we helped build it, and it's just finished a Series C round, and it will soon be the largest maternal health care clinic for the poor in India. Failure actually enables you to succeed often, and if we don't have the courage to own that, we won't succeed. On the other hand, in the off-grid space, one of the great scams has been, and this happened in West Africa actually, government helped get lots and lots of people household systems, so they went from living in the dark, literally, to having the dignity of having light and electricity. When those companies a couple of those companies went bust, people still had their systems, but they had no way to get those systems serviced. And so it was a failure of society's part to provide really now what had become expected as a public service. And so as we're now building a $100 million initiative for off-grid, one of the innovations that we're building is a reserve fund to guarantee after-service guarantees, even for those companies that go not for the companies that go bankrupt, but for individual households that have been served by one of the companies that are invested in, that we know and government knows that those households will not once again be left in the dark. So I think so many of these questions are full of nuance, and we need to really
and we're trying to
hold that.
Deal with it like this.
Yes, no, yes, no.
Right.
But if you're too afraid to fail, you should not be in this business.
Yeah, well
you
said,
will not
Jacqueline,
succeed.
Well said. So I think we have our last question, and it's down here right in front. It doesn't. Is she on?
We can hear you, and Jean can repeat it.
Yeah, we can repeat your question for you. Go ahead.
If I may, to take you all small and really small, I'm from Bhutan, a tiny country in the Himalayas, 750,000. And we talked about how entrepreneurs, social entrepreneurs, access, and culture or network is important for entrepreneurs. And now when you look at Bhutan, 750,000, and a lot of the people don't even know where Bhutan is. And when I work with some young entrepreneurs, and I've also worked in nonprofits, so when I pitch ideas to potential funders or impact investors, yes, impact is there, but then they look at numbers. They look at how far a dollar goes in Africa versus how far a dollar goes in Bhutan. And a dollar doesn't go that far in Bhutan when you look at it in terms of how many people can you impact with $1. Because you're talking of a country of 750,000, that's less than 1 million. And so that in itself, the cost gets high. So I guess my question to the panel as impact investors is, when you look at impact, and we talked about measurements, when you look at impact, you're impacting individuals, but how do you look at it when you can impact, say, I don't know, 200,000 with your $100,000 investment, and you can impact only, say, about 30,000 with your $100,000 investment?
Okay, let's turn to our panel.
Yeah, a couple thoughts. One is, in fact, if you innovate on something in Bhutan, it may be only impact 100,000 people in Bhutan, but that model is likely to be highly relevant for other low-income segments in other countries around the world. So one of the things we do at the Midyar Network, why we have an office in India and in Johannesburg and in Singapore for Southeast Asia, is we try and find those innovations and then rapidly replicate them in other markets around the world. We're also quite active now in South America. So I think what happens in Bhutan actually could be quite important well beyond Bhutan. Question is, who's going to find that investment, right? One of the exciting things we're seeing more broadly in impact investing and also in philanthropy now is that it's becoming more of a global phenomenon. So historically, it's seemed like more of a Western thing, US, maybe some Europe. Now you're seeing a lot of the people who have had considerable success in business in places such as India and China, and also local Africans and South Americans getting into the impact investing game and beginning to build on their homegrown knowledge to make those kinds of investments. So I'm not sure if that means immediate outpouring of impact investing dollars into Bhutan, but I think it's a very positive general trend, and hopefully there are people who are more engaged in that part of the region who see these kinds of opportunities.
And you should go to, like, look at the bank of, I mean, what's the major bank in Bhutan? Look at the board of directors. See who gives a lot of money to social causes, or go to the biggest business in the country's capital. Look who's on the board of directors. Those are the people that are going to care about Bhutan to begin with, and if you can find the ones that have already demonstrated some kind of philanthropic activity, then you can start to paint a picture of how they can take the next step and help build more of an economic opportunity for people in their country.
Excellent.
And if I may just make one plug for your country.
Yeah.
800,000 people, or 750,000 people, an idea can change the world. And the gross national happiness that came out of Bhutan is linked to all of the things that we're talking about today. So what is scale also takes some imagination about the narrative. And connected to that, if anyone hasn't seen the Prime Minister of Bhutan's TED Talk, you must.
Yeah.
Because this is one of the great national examples of how impact investing can change the world. Working with World Wildlife Fund, the government has layered different kinds of capital to take a really big bet, which is zero environmental footprint, or even better. I think even better. Negative environmental.
That's what he said.
Environmental footprint.
Yeah.
And I think in a way, it's what all four of us are talking about. That if we start with the problems that we're trying to solve, we can figure out the capital that's needed. But let's not worry about all of this nomenclature. Let's get on with the job of getting on. But really, you should feel so proud of Bhutan.
Okay. Andrew, I'm going to let you close us out here.
All right,
and then I'll
Dim sum, that's
You
the
have to
answer.
take a vote,
Not
too,
brunch,
Gene,
not
remember.
no. Just a message to all the entrepreneurs
We
in
messed
the
it
room.
all up.
Please, when you sit down with investors of any ilk, ask them what their view is on impact or world positive or whatever the phrase is that you want to use. Put them on the defensive to answer those questions, because that will give you a very strong sense of value alignment, and you will actually impact the way they think about investing. There are organizations like 500 Startups, Y Combinator, now Social Capital, Founders Fund, so many traditional venture firms and social capital being one really innovating from the ground up that are coming into this field just in the venture space of that whole continuum. And your ability to encourage them and show them incredible deals is what's going to keep that momentum going, and we'll see that flourish around the world.
So if you're in this room and you're an entrepreneur with a great idea or an investor with capital, an individual, an institution, it doesn't really matter. We really want to encourage you, if you're sitting outside this tent today, look more closely. Dream big, be bold, take risks, be fearless, and join us in this movement. We're really excited about it. Thanks to our panelists, awesome panelists, and thank you all.
Bravo.